After Donald Trump imposed strict tariffs on Mexico for the second time and effectively blocked part of the border infrastructure, relations between the two countries reached a point that experts from the Latin America Policy Institute call the most dangerous in the last 40 years. The Mexican economy, dependent on exports to the U.S. for almost 82% of its total external supply, came under heavy pressure. Tariffs on automobiles, electronics, agricultural products, and light industry goods cost Mexican businesses, according to estimates from the National Chamber of Industry, more than $45 billion per year. But if Washington expected obedience, it miscalculated. Mexico found an unexpected but extremely painful leverage point: U.S. government debt. According to data from Banco de Mexico's research division, leaked to the press via El Financiero, the Mexican government began gradually but systematically reducing the volume of U.S. Treasury bonds it holds, which have traditionally been a stable element of the Bank of Mexico's reserves. Formally, Mexico claims it is restructuring its reserve portfolio, but Bloomberg analysts note that the timing, exactly after Trump announced new restrictions on cross-border trade, makes the political nature of the decision obvious. And this decision has already caused concern in Washington. Mexico is among the top 10 foreign holders of U.S. debt, and although its share is not comparable to China or Japan, the mere fact of its participation in the process matters. According to Reuters, the White House received a confidential warning from the U.S. Treasury Department stating that if Mexico continues offloading debt at the same pace, it could trigger a domino effect among Latin American countries that have long been dissatisfied with Washington's tariff policies. And this is exactly what Mexico is aiming for now: to create a new, painful trend of pressure on the Trump administration through financial markets and not just through diplomatic statements. But the situation is not limited to bond sales. According to Spain's El País, citing sources in Mexico's Ministry of Economy, the government is actively shifting a portion of its external trade settlements with the U.S. into the national currency, the Mexican peso, and into the euro. This is especially noticeable in the oil and gas condensate sector, where the state-owned company Pemex has already begun testing new settlement schemes through European banks to reduce dependence on the dollar. This is an unprecedented move for a country whose economy has been integrated into the dollar system for decades, and it carries a clear message: Mexico no longer intends to tolerate Washington's unilateral dictates. The political dimension makes the situation even more tense. The accelerated border closure ordered by Trump under the pretext of migration pressure is already causing a collapse in cross-border trade. In Tijuana, Juarez, and Nuevo Laredo, tens of thousands of trucks are idle, and up to $1.2 billion in turnover is lost daily. According to the Wall Street Journal, more than 40% of U.S. auto plants depend on component supplies from northern Mexico, and every day of delays equals a week of losses. Mexico, according to insider Latam, delivered an informal ultimatum to Washington: tariffs will be lifted, Mexico will stop reducing its holdings of U.S. debt, the border will be reopened, the country will restore its previous level of participation in dollar-based settlements. And if Trump expected Mexico not to dare take such measures, the growing concern inside the White House now suggests otherwise. Mexico's sell-off coincided with similar moves by several other countries. As CNBC notes, following Mexico's actions, Brazil and Argentina have also begun considering gradual reserve diversification, creating the sense of an emerging regional trend. Moreover, in the report of the International Monetary Fund published in October 2025, it is stated directly that the share of the dollar in settlements across Latin America is showing stable decline for the first time in 20 years. And this is the result not only of objective economic processes, but also of the actions of the U.S. administration itself. In Mexico City, they understand that if not now, then never. A country that for decades was the junior partner of the U.S. is for the first time using financial weapons equal in strength to any tariffs. And Washington feels that control over the situation is slipping away. And while Trump continues to talk about the need for full border security, Mexico is demonstrating that today, security is not only walls and border guards, but also the holders of U.S. debt. And if Washington's actions do not change, the debt sell-off will continue. and then America will be the one who has to make concessions. Especially dramatic for the US is that according to analysts at JP Morgan, Mexico's debt sell-off began at the very moment when the American Treasury market is experiencing increased volatility due to the budget deficit and rising defense spending. In a closed memo that leaked to the New York Times through a source in the US Treasury, it is stated directly that every percent sold by our neighbors increases pressure on the cost of servicing the debt, and we cannot ignore the risks. Analysts call this phrase unprecedented. Never before has the US acknowledged a threat from such a close partner as Mexico. Moreover, according to Bloomberg Mexico, at the current stage, Mexico is considering expanding its reserve diversification program, including purchases of gold and eurobonds of the EU, which in itself is a political signal, because such steps in fact mean shifting priorities toward Europe and abandoning traditional alignment with the US. And as the Financial Times notes, the largest Mexican exporters are already moving part of their contracts to settlements through European clearing centers because they fear that dollar operations may come under pressure from Washington. Thus, Mexico is not just offloading US government debt, it is demonstrating readiness to change the very structure of its financial flows, making it clear to Trump that tariffs and a closed border will cost Washington far more than he anticipated. And against this backdrop, the US for the first time has begun to seriously discuss the possibility that Mexico could become the trigger for a far larger crisis of confidence in American bonds. According to CNBC citing former Fed officials, if previously the concern was about China's actions, now the threat is seen from a completely different direction, from the closest trading partner deeply integrated into the American economy. And this is why Mexico's debt sell-off is perceived in Washington as a blow not to the numbers, but to the symbol. If even neighbors in the USMCA who depended on the US for decades are starting to dispose of the dollar, it means the system has cracked. In an analytical memo of the US Congress, excerpts of which were published by The Hill, it is stated directly that Mexico's actions may create a precedent that will undermine other allies' confidence in the debt sustainability of the US. According to the Latin American online outlet Proceso, Mexican officials are deliberately conducting confidential talks with Colombia, Chile, and Peru on a possible partial shift to regional currencies and the euro for settlements in agricultural products and oil. These countries are acting cautiously for now, but the very idea of a Latin American currency corridor is already being discussed at an expert level. If this happens, the effect on the US will be devastating. The dollar will lose dominance in a huge market that for decades served as its quiet pillar. At the same time, according to Politico, Trump has already convened several closed meetings with the Secretaries of Commerce, Treasury, and Homeland Security, trying to find a way to force Mexico to back down. But the problem is that there are almost no levers left. Tariffs have already been imposed, the border is already partially closed, and now every additional escalation will hit American companies even harder than Mexican ones. In the White House, there is a growing awareness that Mexico has trapped the US. If Trump does not lift tariffs and reopen the border, the debt sell-off will continue. If he makes concessions, it will be seen as a political defeat. And according to analysts at Goldman Sachs, exactly this scenario may become the turning point in relations between the two countries.